After all of the fuss caused by the Bank of England's latest studious round of inactivity and 7-2 vote not to raise interest rates, company news should come to the fore in the week ahead. Although just 3 FTSE 100 firms are scheduled to make an announcement, a whole legion of FTSE 250 and small cap firms are set to release figures. From the FTSE 100, the ones worth looking out for are United Utilities trading update on Tuesday the 26th and SSE's latest trading comment on Wednesday the 27th. Among the mid and small caps, names to note include affordable housing and land regeneration expert MJ Gleeson on Monday the 25th, insurance, car recovery and corporate punch-up specialist AA on the 26th, fashion phenomenon boohoo.com on Wednesday the 27th, acquisitive plastic packaging play RPC on the 28th, and veterinary care company CVS on Friday the 29th. But for all of those, the name most likely to cause a fuss in the week ahead could well be stricken support services company Carillion, when it releases its first half results on Friday the 29th of September. In some ways, the share price chart gives you the headline story at Carillion, and it doesn't make for great reading. So what exactly has gone wrong? Well, first of all, the support services sector overall has largely fallen from favour after a series of scandals, profit warnings, changing to accounting practices, or all three at peers G4S, Serco, Capita, Mighty and Interserve. This is the chart for the FTSE All-Share support services sector over the last 2 years. Second, Carillion uncorked a huge profit warning in July. The firm cited a revenue shortfall, lower than expected gains from the sale of public-private partnership contracts, and $845 million in provisions to cover problematic contracts in the UK and a withdrawal from the Middle East and Canada. Third, the company announced that the combination of a lower than expected profits and rising debt meant it would not pay a dividend. This is the company's dividend history going back to 2010. After that summer shocker, Chief Executive Richard Howson quit immediately, ending his 5.5-year term at the helm, and Chief Financial Officer Zafar Khan left earlier this month. Mr. Khan was replaced by Emma Mercer, and Carillion announced a number of other changes at the executive board level. That brings us to the interims. Some investors may be tempted to take a look at Carillion on the grounds that its share price has collapsed. The worst may be in the price, and peers such as G4S, Balfour Beatty and Serco have restructured and begun to win over investors once more. That remains to be seen, and 2 big issues to watch out for are the identity of the new chief executive. Keith Cochrane is acting as the interim boss, and as former chief executive of oil services company Weir, he is very experienced. Any news on the strategic review of its operations with Carillion is undertaken with consultants EY. In terms of the numbers, watch out for 3 things. Any change to revenue guidance. With the July warning, Carillion steered its analysts to full-year sales of $4.8 billion to $5 billion for the year. That's down from the $5.2 billion chalked up for last year, as we can see from the chart here. Any full-year profit forecasts. The consensus is currently looking for a pre-tax income of $138 million, down from $147 million last year. At the interim stage in 2016, by the way, Carillion made pre-tax profit of $84 million. And finally, net debt. This is the biggest number of all, and in more ways than one. Net debt ended last year at $219 million, but it averaged $587 million over the year, and there was a $663 million pension liability on top of that. Some analysts think the number could get as high as $900 million, a figure which they think could prompt Carillion to have a rights issue, a cash call from shareholders to steady its finances. If Carillion can convince the market it has a credible plan to boost profits and reduce the net debt, then the shares could rally, but that is a pretty big if. Whatever happens, this is not a stock for widows, orphans, income seekers or risk-averse investors. Only aggressive capital gain seekers should look at this one, and they should do so with their eyes wide open, remembering the old saying, what is the definition of share price that has fallen by 90%? One that fell by 80% and then halved again after that. Thank you very much for watching, and I look forward to seeing you again next time.